Section 12J, I think we're all quite familiar with it by now, and despite some serious lobbying for its extension leading into the national budget in February, Treasury decided to allow the sun to set on Section 12J, and it's an incentive that has seen roughly 11 billion rand raised by fund managers from private investors to deploy into qualifying venture capital companies. And quite frankly, it was disappointing. I was disappointed because what we were seeing was highly successful fund managers deploying capital into businesses that need capital at this time, because COVID has impacted all small businesses and it provided a lifeline. And as COVID-19 causes South Africa's fiscal deficit to bulge even further, perhaps a little less than anticipated, thanks to the recent better than expected tax take numbers that we've seen and into the first quarter of this year, the question remains, what role should and could incentives like Section 12J play in supporting SMEs through the crisis? And it seems a little bit after the fact, but I do hope that Treasury relooks at the decision. Anyway, I do think there were some issues that were merited, but I've said it in the past, it smacked of sort of throwing the baby out with the bathwater. I recall chatting to Dino Zakalo as chair of the industry organization Section 12J Association at the time, and there's one word for it. He just said disappointing. So with that, we do still have a small window to take advantage of this incentive, a couple of months. And that's why we're presenting this series of webinars. And we're going to introduce you to some very innovative Section 12Js and how you can still take advantage of the incentive while it is still available. If you've got questions, please type them into the chat box. The beauty of a webinar is that we can curate all the similar questions and then we can get through as many as possible, rather than raising hands and going one by one. Well, with that, I'd like to welcome Alexander Babich. Alex Babich is the MD of Alexander Babich and Associates. They're a leading independent financial advisory and employee benefits consultancy firm. They've been around for some time, founded back in 1999. So just slightly younger than I am, just kidding. After graduating from the University of Natal in natural sciences and maths, Alex worked as a senior executive consultant. He's worked with various firms of consulting actuaries and consultants, but he's not one of those actuaries who likes to look at your shoes when he introduces himself. He's a real character. He regularly talks on radio and TV and currently also serves as a deputy chairman of SAIFA, which is the South African Independent Financial Advisors Association. And that is the liaising body between the investing public, the media, and the FSCA. So with that, Alex, I'd like to hand over to you.
So welcome to all the listeners and viewers out there. Again, I'm just going to skim through a couple of slides, what's been happening. I'm going to look at the macro picture of how financial planning works and how things like Section 12Js fit in the picture. Because it's not how much you earn sometimes, it's how you earn it. And of course, tax has a big influence on the way we earn our money. I'm going to run through some interesting slides that we've done at SAIFA and other institutions about tax. But let's run through a quick few slides. Alexander Babich, as you said, Michael, we are point number one. First of all, we're 100% independent. We're not a product service agent. We don't represent any company. Geltec has invited us to come and talk today. And as I said, we do business with Geltec and many other 12J companies, but we do find Geltec, having done a due diligence on them, are very good as a 12J company. And the results, I might compliment Jonty, have been exceptionally good. So we're happy to partner with Geltec. We're not owned by any financial institution, number two. We're client focused, number three. People in our research are our differentiator. We liaise with many different organizations and people, and we actually have full-time actuaries that work with us. Number five, we obviously work with the employee benefits as well. So we get institutional pricing with our fund managers and product providers. Very importantly for all of you, you know, how we get to know companies like Geltec, we ask for references. So when we do business with companies, we make sure that the references are rock solid. And then number seven, I think this is important. I'm going to touch on this very briefly. We're going to look at the psychology of retirement, but that also applies to what's been going on in the market, panic and fear. I didn't tell you this time last year, there was a lot of fear and a lot of panic. Just think back 12 months ago, guys. I think it's fair to say that everyone was thinking, what the heck's happening here? suddenly where the world went into lockdown. You mentioned about Saif, I won't go into that. And last but not least, we partner to ensure investors obtain value, understanding, how's that for a spelling error, and investment certainty. So with that in mind, let's see what happened quickly to the viewers out there. You know, what's changed? In 2019, I did a presentation with the head of Stanlib. That's Kevin Lings. He's the chief economist of Stanlib. And we did a presentation in February before the coronavirus pandemic really exploded. And we said, what could go wrong? Coronavirus, we had oil trade wars. Remember, the oil price was going all over, and we had you know, Trump fighting with China, and there was all the talks going on there. But you can see throughout history in that graph that you can all see there were a whole lot of things happening: stagflation, the Reagan era, tech booms, global financial crisis in 2008. The markets then took off thanks to all the stimulus, the printing of money, the quantitative easing, and then suddenly this coronavirus was looming somewhere distant in China. Now, what is this going to be different? One of the most famous investors of all time was a guy called Sir John Templeton. You should look him up. It's not just Warren Buffett. And he said the four most dangerous words in investing are, this time it's different. Now, what happened in the marketplace? We all panicked. We are psychologically as investors wired a certain way with the different behavioral graphs we're going to show you. But to be fair, 2020 looked a bit different. And I think the toilet paper example of empty shelves sort of exemplified what our thinking was. I can remember the panic going to Woolies myself and seeing shelves being emptied out. I mean, even myself, I bought an extra freezer. So we all had this thing, what on earth is going to go on? Is there going to be enough food? Are supply chains going to be disrupted, etc.? What is this coronavirus going to do? And of course, this little virus caused absolute pandemonium initially. But you can see that this fear soon translated into a recovery. You can see this graph here. It's called the behavioral report for the class of 2020. You can see the all share index, although it dipped down dramatically in March, roughly a year ago, you can see it started to recover, and it recovered and it recovered until about August. It started to get a lot healthier, and you can see the markets rebounded a lot quicker, which caught a lot of investors off guard. So those investors that sold low and bought back too late after the recovery eroded statistically about 20% of their portfolio. So we're different types of investors. We've got different profiles. We've got conservative, typically moderate and aggressive, but there are more subcategories to that, which I'll talk about. And obviously you can see what's happened to the market subsequently. So this goes from January of last year to December. And you can see there was massive volatility, and people don't like volatility. We don't like uncertainty. We don't like unpredictability. So you can see there, this research was done by Momentum. In the COVID-19 panic case study of 11,600 switches over 1,000 Rand, I want to show you the damage done by trying to market time or guess, or this time it's different. Now there's different types of investors. You can see a couple there. I can't see them all in my screen here, but you can see there's different types of investors, ranging from the one at the top to anxious, to contrarian, to the risk avoider, to the market timer. In generic terms, you'd have the conservative, the moderate, and the aggressive investor over there. So an aggressive investor might be thinking he's a market timer. He can guess the market. But as the viewers will see, we are very, very poorly wired to guess the market accurately. We're generally quite shocking at market timing. In fact, one would argue market timing is the most difficult thing to get right. But you do have contrarian investors, and Warren Buffett will be a classic one regarding this. He would say, buy when there's blood on the floor and sell when everyone else is buying. So he would be a contrarian investor that is well known. But you can put yourself in a category there. Where do you sit? To the viewers out there, where do you sit? Are you a contrarian? Are you a risk avoider? Are you a market timer? Are you an anxious investor? They're different profiles. But we're going to concentrate on one type of profile. That's the anxious investor. You can see there in this graph. And again, using the Momentum survey, there was a spike of over 300% of activity during the crisis. People started to trade. People started to panic. People started to sell, buy, do all sorts of things. And the net result is, of the people sampled, about 100 million rand was just lost alone in April to December of people just trying to switch. And on the peak, it destroyed about 19.44% of value. So they took a survey of all the people that were switching, these 11,500 people per switch in August. So people that try to get back into the market on average lost about 19.44%. And these typically were the anxious archetype type of investor. And you can see there that to try and guess the market, this time it's different, is very difficult to do. I would argue almost impossible in some of the cases, because when you're panicking, you're not thinking rationally. So approximately 1.5 billion rand in the survey was switched, and you can see the average portfolio destruction was about 6.5%. So you can see that market timing and the type of investor you are, whether you're anxious, assertive, or whatever your profile is, has a profound effect on your investment performance. So it brings me back to the middle of my presentation. Why is asset allocation so important? So the message I keep drumming in over and over, Michael and Jonty and the listeners, I keep drumming this over. It's like the Holy Grail. Why is asset allocation so important? It's a bit like the periodic table in the science. You remember in the science labs, you had these periodic tables and you had all the elements, and how you mix the elements together, you get a different outcome. If you mix certain chemicals, you get an explosion. Other chemicals, you get a mute reaction. But Sir John Templeton, who I mentioned earlier, saying this time is different, said that asset allocation and diversification are the foundation stones of successful long-term investing. And I'm sure your sophisticated high net worth individuals that are listening in today would appreciate the value of that. The proverbial, don't put all your nest eggs in one basket. And then one of the most, a Nobel laureate, a guy called William Sharpe, said, an average of 90% of monthly variation of returns in a large sample of mutual funds, of course, mutual funds, you would know them as unit trust, is explained by allocation. And he attributed 10% of performance is explained only by specific share allocation. So that index, that positive, index tracking funds versus active funds. Getting the share selection right is very difficult. So you're seeing a shift towards index tracking funds quite significantly globally, because it's very difficult for active fund managers actually to beat, especially with algorithmic trading and all that, to beat passive funds today. So William Sharpe made these observations, and we then can sort of summarize this in a quick graph. It says why asset allocation is important. What drives long-term performance? You always hear these adverts, long-term, long-term, long-term. Well, about 91% of asset allocation in certain studies showed that asset allocation drove the performance. So how you put your money in cash, bonds, property, and equity, that drove performance. Only 5 to 10% could actually be attributed to your specific security that you were buying. In other words, if you bought retail shares versus banking shares versus mining shares, or you try to get your security, you try to know which shares to buy and which not to buy. Other factors could be things like costs, which do have an impact. One of the reasons we like Geltech, for example, we thought, Jonty, the reason why we started using your products over your competitors is your costs were very reasonable, very transparent. And very importantly, Geltech, you allocated your asset, your funds very efficiently. We found many of the other 12J companies weren't effectively allocating their money as efficiently as you were. But profoundly enough, only 2% of performance could be attributed to market timing. So market timing is probably the most difficult thing to get right. Your only free lunch is probably your asset allocation, your diversification, the spreading of your nest eggs. So as allocation is important, but very importantly as well, is if you look at US equities, South African equities, and the Morgan Stanley Capital Index, I want to show you something very interesting. You will note since September 2018 at the bottom, till about September 2020, at sort of the peak-ish of the coronavirus, you can see that the Johannesburg Stock Exchange was doing quite poorly. It was doing very poorly. Can you see, everyone see that graph? And then of course, March, the markets tanked there, and then they made that recovery where a lot of value was destroyed. So people that panicked and sold here and didn't come back at the top, lost out. But you can clearly see a big disparity between US equities, the Morgan Stanley Capital Index, these are the index of the world index, and the US equities running way ahead. So if you had gone in offshore equities, particularly the US, you would be looking like a hero. If you were sitting here in South Africa, you would not be looking great. So you can understand that for the last couple of years, equities locally weren't doing particularly well. The JSE was doing less than 2%. Of course, overseas was stimulated by central banks just printing money, but watch how quickly things change. This is why it's difficult to market time. I put it to anybody out there who predicted the spectacular increase in the Johannesburg Stock Exchange. To the extent, if you look at this graph from Nedbank, up until March, the FTSE all-share index did 53%. That's astounding. So it's amazing how from September of last year to now, how spectacularly the JSE's recovered, particularly because of the mining sector and property, which was an absolute bloodbath over the last 7 years and 5 years, suddenly also recovered. Who predicted that? It's very hard to predict. But interesting enough, for the long-term investor, I want to show you something, another very interesting I've circled here. Can you see the all bond index? That's bonds. Remember, we were junked. We were going to junk status. Everyone was panicking. Our bonds are terrible. Bonds are doing badly. Look how well bonds did. Bonds actually beat the Johannesburg Stock Exchange over a 5-year period. And then you can see over 3 years, the JSE looking a little bit better. And then, of course, the recent spike up in the market, bonds doing about 16%. Nothing wrong with 16%, by the way. But you can see compared to the JSE, much higher. And of course, US equities were steaming ahead with all that money being printed. So it shows you how the fortunes of the market have changed within a very, very short space of time. If you were out of the market for the last 6 to 9 months, you've missed on that upside. But how many of you investors, honestly, listening in today, would have been able to handle 5 years of going nowhere? If you just bought the Johannesburg Stock Exchange and made 1.8, 1.9% for 5 years, you would say, wow, I'm going somewhere else. Then, of course, you rush overseas. The rand dollar comes back from 19 to the dollar to about 14.50. So the rand's appreciated massively against the dollar and other currencies. And of course, the JSE hits the lights out. And of course, the JSE is one of the best performers. So my conclusion is, where do you sit in conclusion with investors in the business of making rich friends? Now, Momentum Securities just showed you what an unequal society we live in South Africa. At the moment, there's about 17 million people on social grants that earn less than 3,500. Then there's about 12.5 million that are the survivors. That's increased, by the way, to 300,000 people. You can see since 2017, the Jacob Zuma years, how indigenous people or people just above the breadline, how many people have increased there. I mean, a massive amount of people, 7 million going from earning less than 3.5 million. A lot of people earning less than 8,000 Rand. Skilled strugglers, they've also increased. Those are the people that earn 8,000 to 22,000 Rand. And this is where probably the most of the viewers sit. If you can see the line, the top 15%. In conclusion, the top 15%, which is you, are paying the burden of taxes. And that's going to bring me into Edward now, who's going to talk. Ever considered what your effective tax rate really is? 58 cents to the Rand of your money, of the listeners' money, typically are going to direct and indirect taxes. 45% marginal tax rate, and other taxes like municipal tax, transfer duty, CGT, fuel tax, sin tax, VAT, all that adds up to about 58 cents to the Rand. That's why 12J investments have their part. How do you reduce the tax? It's not necessarily how much you earn, it's how you earn it. And that's where tax planning comes in very importantly. So I conclude by saying, what are your needs, wants, and your cash flow, listeners? Do you know all your options are regarding transferring, investing, your retirement options? And in the case of Geltech and other 12J companies, have you thoroughly compared products and services to carefully ensure you've received independent advice? Are your investments optimally invested locally and internationally in the most tax efficient way? And we're going to talk about 12Js. Do you have a current will to protect your loved ones, et cetera, et cetera? So in conclusion, are you in full control of your financial and tax affairs? So we're going to lead you in now to the tax affairs. If you do want to send us questions, as Deputy Chairman of SAFER, we like to engage with the investing public out there. If you need independent research in that, please call Edward or myself. And that's concluding my part of the presentation. Over to you, Michael.
Thanks, Alex. Fascinating. I need to have you on the show running through that presentation. I just think the psychology of the way we responded to COVID is such a perfect example of why we need outside advice. Because even the most savvy investor with the biggest testicular fortitude in the market would have been scared by what happened at that time. And you need to go back to those principles of Sir John Templeton, Benjamin Graham, and some of the other greats of the investing world. With that, I'd like to hand over to Edward Rodd, who's going to take us through some of the Section 12J fundamentals. And it's interesting, today is Cinco de Mayo over in the US, and it's a big holiday over there. I think 70% of Americans celebrate Cinco de Mayo. The interesting thing is that only 1 out of every 10 Americans actually knows what Cinco de Mayo is. So I think many people follow the herd without actually understanding why they're doing it, what the fundamentals are. So Edward, over to you to touch on those fundamentals.
Hi, Michael, thanks so much. Can everyone hear me, hopefully? So
Loud and clear.
basically, I'm just going to touch on, just a basic refresher, as Janti and I were saying earlier this week. So I'm just going to go through a basic refresher for everyone in terms of 12J and what they are and who benefits from them. And thanks to Alex for that great presentation. I think it's always nice to listen to him and what he has to say. So hopefully everyone can see my screen. I'm just going to make sure let's see my screen. Okay, there we go. Control Alt Delete and start again. There we go. So obviously you get the tax deduction, 100% upfront tax deduction. It's obviously claimed in the year in which the investment is made. You obviously, one of the not cons, I suppose, but one of the elements is that you have to hold the investment for 5 years to get that tax benefit. The limits are 2.5 million per individual trust and 5 million per corporate. And then obviously, just to make all the listeners and viewers aware that obviously the sunset clause has recently been introduced and shortened to now 30th of June 2021. So we have less than, let's say, 60 days to make sure we get our 12Js in for the final opportunity. The ideal investor is obviously your individuals, companies, and trusts with obviously significant income tax liability or capital gains tax liability. Just in terms of your income tax, just a brief overview of how this would work. So an individual who has a taxable income of 10 million, no 12J investment, you have no tax saving. Obviously, with the 12J investment, obviously this is quite simple tax calculations, not going into full on, exactly line items, but the basic for an individual contributing 2.5 million, their new taxable income is only 7.5 million. So they effectively have a tax saving of 1.125 million. In terms of capital gains tax, if you have a purchase price of 10 million, you sell your property, your share portfolio, your business for 50 million, you've had a capital gain of 40 million, taxable income at 40% inclusion rate. If you do a 2.5 million rand 12J, you then have a tax saving effectively of 1.25 million, which is, obviously significant. In terms of limitations, your 5-year investment term, the sunset clause, which is coming up now at the end of June, and the capital gains tax on exit, which I don't think a lot of people are aware of and which I'm going to touch on now. So capital gains tax on exit of an investment. So this is just an ordinary investment, just to explain to the viewers on how normal capital gains tax works. You have an investment of 100 Rand, you then after 5 years have 150 Rand. Base cost is 100 Rand, your capital gain is 50. Your CGT at exit is 9 Rand, your net benefit after CGT is 141 Rand. So effectively your IRR is 7% for that period. And now I just want to compare, obviously if you do a 12J investment, so the biggest change is that when you do a 12J investment, your base cost is actually at 0, not 100. So that's where the differential comes in. Your capital gain is then viewed at 150. Your CGT at exit is 27 Rand. And then your net benefit's 123 Rand. So But the thing is, with your 12J benefit, if you were a 45% marginal tax rate earner, you then get a net benefit of 168 Rand. And this is, including the time value of money, your IRR is then 17%. So with you doing that full maximum 12J investment, you're getting an extra 10% return on your investment, which is a no-brainer, Alex and I often say. But yeah, so that's just a little refresher to the viewers out there. Sorry about all the technicality issues and all of those issues, but hopefully it was informative. And yeah, back to you, Michael.
Yeah, Edward, it wouldn't be a webinar without a few technical gremlins creeping in, as you say. I would
Alex always says that the youngsters are the one. I have to help him with his presentation sometimes with technology, and Karma came around and sorted me out. But anyway,
I'll happily take the technical gremlin rather than being stuck in traffic for half an hour on William Nicol or something like that. So Edward, thank you very much for that refresher and just for going through the CGT question as well. And I think it's an important element that is often forgotten about. And it does have an impact, but as you showed, I think overall, the overall benefit is an absolute no-brainer in an environment where returns have been so difficult to come by locally in the listed space in particular. I'm going to hand over now to Gaurav Nair, who is going to give us an overview of the Infinity Anchor Fund. And it really is a phenomenally performing fund. So I've got a few questions, Gaurav, for you after your presentation on how you've differentiated and how you've achieved such phenomenal results. Gaurav is qualified as an actuary. He completed his degree BSc Honours at the University of Wits. He's a co-founder of Geltech, and he's also the CEO of Infinity Anchor Fund. Gaurav.
There we go. I think I'm unmuted now. Let me just share my screen and get going here. Okay, there we are. Thanks for the intro, Michael. So yes, I'm here today to talk about Infinity Anchor Fund and really give you a sense of our approach to investing, what our performance has been like, and to highlight some of the noteworthy investments we've made recently. Today, we're coming to the market in June with 2 investment options. The first investment option is called Infinity Performance. And this has been the fund that we've been running for a number of years. It's arguably been the top performing fund in its sector. And it's been tracking a return of 15% plus per annum. That measure is a measure that includes the tax benefit. And really we use that measure because a lot of the 12-year funds talk about that measure, but you'll see we also talk about measures without any tax benefits, which just shows the performance of the underlying investments. We've been tracking 100% deployment, which is a very key metric in achieving good returns. Funds that deploy their money slowly, of course, they have cash drag for a longer period of time, resulting in investors earning just interest instead of earning better returns. And that really hampers their performance. We've maintained a good track record of paying 6 monthly dividends, with the last dividend that we paid being about 5.1% annualized. And as mentioned previously in Alex's presentation, our performance fees are charged only on the performance we provide, whereas some fund managers, they charge performance fees also on the tax deduction. And as you can imagine, this results in quite a high performance fee, hampering returns as well. The other investment option is Infinity Stable. And Infinity Stable is a product that we designed that is the answer to a lot of hesitations that some people had around Section 12J. And what it is it has an income stream that's underpinned by guarantees from large financial institutions. The return of capital is also guaranteed. And what this leads to for investors is it leads to predictable returns, a predictable exit because the liquidity event is guaranteed, There's no performance fees charged within Infinity Stable, just the annual fund management fee. And we have a low minimum investment size of 100,000 Rand. But more on that in a bit. So Infinity Anchor Fund, we invest into the equity capital of asset rental businesses. By their very nature, these businesses, they have all these assets they're renting out on their balance sheet. So it's asset backed. And they have contractual cash flows and regular cash flows, resulting in overall a moderate risk profile. Also, they lend themselves to a clear exit strategy by their very nature. We target investing 100% of funds. Now, the reason I mention this is that some funds out there, they only target investing 80% of the funds and holding 20% in cash. And this is unnecessarily being risky because 80% is the minimum amount that the funds need to be invested in order to be compliant. So we, of course, target investing 100% of capital, which also results in better returns for the investors without having that element of cash drag. And as I mentioned, we only charge performance fees on gross capital. So that is only on the return that we provide, not on the tax benefit. We also spend quite a bit of time and effort focusing on risk mitigation. So every one of the investments we make has all 5 of these characteristics. Sometimes we structure in additional risk mitigations on top of this. And in one of the investments I'm going to highlight, I'll talk you through that. But what we do is we require that every time we invest into a business, the entrepreneur or management team, they co-invest with us 15 to 50% of the total capital requirement, depending on the riskiness of the business. Their capital acts as a first loss. And so what this means is that in any adverse events where the capital is eroded, it eats into their capital first, protecting Infinity's investors. In addition, we structure in contractually a step and right. Fortunately, we've not had to use this to date, but we have it. And what it is that if that first loss capital provided by the entrepreneur management team is eaten into, and it passes a certain amount of that capital eaten into, then we have the right to appoint the controlling number of directors and take control of the company, and then remediate the situation. Also, our capital has preferential dividends. And what this means is that the first returns that the business produce goes to Infinity Anchor Fund. And finally, what we also structure in contractually into the shareholders agreements is a liquidation right after 4 years. So this is one way that we ensure that we get the money back timelessly to return to our investors. How it works is that from year 4 onwards, all the cash flows the business generates, we have a right to insist that they are paid out as dividends. And the very nature of rental contracts is that they're self-liquidating. Over time, you're getting capital and interest back. However, we can waive this right if the entrepreneur or management team has a way to exit us in year 5. And so this ensures a timely exit for our investors. Now I'd like to highlight some of the noteworthy investments that we've made. This is to give you a sense of the type of businesses we like to invest into. The first is a business, EMFS. And what they do is they do long-term rentals of luxury vehicles. And what we saw when we due diligence this business is we saw that that was a sector of the market that had not been adversely affected by COVID. They had been quite insulated from COVID. They didn't have an increase in bad debts. They didn't have an increase in their overdue payments throughout COVID. And we ended up investing at the end of last year. We've invested 20 million Rand. In addition to the normal first loss of 25% that they've put in addition to that, they have guaranteed the return to Infinity Anchor Fund of 9.18%, and that's excluding the tax benefit that investors get. The next investment I'd like to tell you about is a business called Dorleen. Dorleen's been in business for about 18 years. Similarly to EMFS, we saw them perform extremely well during the COVID period. So with the advent of the COVID crisis, and lockdowns, etc., we wanted to make sure that all the investments that we invested into performed robustly during COVID. So that is that they had low bad debts and they didn't have lots of overdue payments. What Dorleen does is they rent out cars to car dealerships while they are selling the car. So while the car's on the floor during that month, they rent it out to them until the car is finally sold. They operate in about the 100,000 Rand mark category, and they saw an increase in business as a lot of people stopped buying new cars or moved down the price point. And this is an area in which Dorleen sees very little competition. The big four banks, historically, even pre-COVID, have not been playing in this space. So it allows Dorleen to earn very good returns that we can pass on to our investors. They've been in business for 18 years, and their risk mitigation is so good that despite their revenue being in the hundreds of millions, over the last 18 years, their total losses has been in the hundreds of thousands. So really an amazing track record. The return that we're expecting is 12.6%, again, excluding the tax benefit. Another investment that we made a few years ago, over 2 years ago now, is into SecuTech. What SecuTech does is they invest, they rent out security technology. And the security technology is rented out to corporates and apartment buildings, etc., to the body corporates. And it's such a electric fencing, cameras, etc. It's often rented out as part of a full package of armed response, monitoring of the cameras, and so on. And so this holistic service allows the charging of a premium price, resulting in good returns for our investors. We're achieving an IRR of about 9.73%, excluding the tax benefit. And then another investment that has done really well for us is Rise Telecoms. They're the developer and owner and operator of fiber infrastructure, and their revenue is from people paying for internet access. As you can imagine, with COVID and more people being at home, the rise of video conferencing and webinars and people spending more time on Netflix, etc., they've seen huge demand. It's performed really well for us, 9.45%. And we expect that they require more capital. The business is doing very well. And so we have the opportunity to invest more capital with them now. So just a bit about our performance results. We've achieved an average dividend yield of 5.1% for our 2019 vintage, which has been going for a few years now. On the net capital, that's excluding including the tax benefit, it's 9.27%, the dividend yield. Ignoring the tax benefit, the return on gross capital has been 5.22%. That's after all fees and taxes. With the tax benefit, that equates to about 15.35%. And we're tracking a speedy deployment of 100% of capital invested. A little bit about our pipeline of investments. Just a bit about COVID and what the impact this had on our pipeline. Conversely to what people may expect, our pipeline of businesses improved. And the reason it improved, our theory in terms of what we were seeing, our hypothesis, was that a lot of businesses that were doing well and hence needed more capital to grow, not because they were in trouble, they found themselves with the banks and so on, not willing to extend them more capital because the banks, etc., their risk appetites had diminished. And so we started seeing really good deals, and we actually started seeing better deals coming to us for funding, really, and willing to accept a higher cost of capital. So the pipeline is about 350 to 500 million Rand. You can see it's across a variety of sectors, returns from 10 to 25%, and a large deal of the pipeline, they've signed exclusive deals with us. So we're the only ones that can invest with them. This graph here just shows Infinity's performance against that of our largest competitor. And to the left of the line is our actual performance. To the right of the line is a projected performance. Our competitor's performance is projected by them. This is their projection. And as you can see, their performance dipped, and then they project that dipped performance forward. So this results in up to a 15% difference over the 5-year period on gross capital. Quickly about Infinity Stable. So Infinity Stable also invests into asset rental businesses. However, these asset rental businesses, they have contracts with financial institutions, and these financial institutions have large balance sheets, very secure. They guarantee the performance of the underlying business. They guarantee the income stream, and they guarantee that after 5 years that they will buy out the asset rental book. This leads to a predictable exit for investors. They have peace of mind. They'll get their money back after 5 years, and it leads to a predictable return for our investors. The stable, of course, because of its, because of its slightly lower risk profile, has slightly different economics. There's a net dividend yield of about 2% per annum. That's including the tax benefit. It leads to a return of about 10.95% per annum. And this return is floating. So it's actually prime plus 3.95%. So as prime climbs, it's also expected to climb. As I said, there's a guaranteed underlying investment. There's a guaranteed exit. And we expect to have 100% of our capital that we raise in June deployed by the 31st of August. Thank you very much.
Thanks a lot, Gaurav. And I think if you survey the Section 12J environment at the moment, it's fair to say that this is a class-leading fund. So why is it? How have you managed to differentiate in an environment where you've got a lot of fund managers out there who surveying equally attractive investment opportunities, surely, that you've managed to deliver something that is market beating?
So I think our main focus has been on deployment, on deploying the money as quickly as possible. And most fund managers, they come out with a strategy and they go out and raise money based on their strategy and the experience of the management team. And then after that, they go out and find the businesses to invest into. Whereas our approach from the very beginning has been to have the pipeline of businesses ready, contracts signed, and then to raise the money so we can deploy the money speedily. And really, this is a problem that if you take the approach of first raising the money, it's a problem that grows on you, because as you raise more and more money, that's all going to the back of the queue, and you still have the old money to deploy. And this then leads to lower cash drag and then better performance results.
And I think, with what Treasury were pointed out to behind the sunset and actually not extending Section 12J, I think that speaks to what you've just said. There's a lot of dry powder out there, a lot of funds that were raised. Out of the 11 billion, I think only just under half has been deployed. So it speaks to that general approach in the market as well. With that, I'm going to hand over, thank you, Gaurav. I'm going to hand over to Jonty to talk to us about Geltech. Just give a brief introduction to Geltech Solutions, and that'll probably leave us with about 10 minutes to take Q&A from the audience. So please remember to type your questions into the Q&A box or even into the chat function if you want to, and we'll try and answer as many of those as we can. Jonty, over to you.
Michael, thanks, Michael. Hi, everyone, and thanks for taking the time. So, as a business, we realized that if Section 12J wasn't extended, that there'd be a number of investors who'd want to invest in June, but simply don't have the capital. They understand they will have a tax problem in the year. Maybe they're an executive or a doctor earning, the same amount every single year, and they have a good understanding of the tax position, or they know that they're going to be selling a property or a share portfolio or a business, and they're going to incur a capital gains tax event. So we knew that these taxpayers are around, but they might not have the money in June to invest. So we worked on raising capital in a third-party fund, in a national credit regulated entity, and we have a significant amount of money that we can assist investors with investing into our funds. And it comes at a really, really interesting rate. So now we can offer our investors funding of 95% of their investment amount. So let's assume for a moment you need to invest R1 million. All you would need to do is invest 50,000 Rand. We would facilitate funding of 95%, or in that example, 950,000 Rand. And you would then obtain an investment or a share certificate in an Infinity Anchor Fund to the value of R1 million. That R1 million will allow you to reduce your taxable income. And then in 2022, claim a refund of up to 450,000 Rand. So in the example I gave, you then invest R1 million. From June until October next year, you would pay interest at a rate of 4%. Because the rate is so low from now till October next year, we foresee two types of investors would be interested in funding. One is an investor who doesn't need the funding, but realizes that at an interest rate of 4%, they can do better with the capital that they currently are sitting on elsewhere in the market, potentially chatting to Alex and Edward and finding which investments are available and which generate more than 4%, and wait until October 2022, October next year, when the interest rate goes up, to then pay off either all of the loan or 45%, which is required. So that's our typical client. Our second client is someone who simply invested in February, doesn't have the cash immediately, understands the tax liability, and wants to make an investment, and will then elect to pay off, either all shortly or over the 4.5-year investment term. So effectively what happens is the investor will invest from now till October 2022, the interest rate will be 4%. That then increases from October to February to 9% fixed. And then from February to the end of the term at prime +2. So it's a really, really low interest rate. It's very attractive for investors who are going to invest into Section 12J in any event. The only security we require is the share certificates and the dividend payments. Obviously, there's an obligation to pay. The first payment obligation is only in October 2022, and every October thereafter, approximately 20%, and in the final year, 18%, and all depending on the client's interest rate and payment. So this is available. It takes really a short period of time. An application form would have to be completed, and within 24 hours, we can assist taxpayers or investors. We've done this already for a number of investors in our June for our June investment. So if you are interested, what I will do is after this presentation, probably on Monday, is I will circulate the recording of today's presentations together with information. And if you are looking to make an investment with us, complete the information and we'll be very glad to assist. Great.
Super. Thanks, John C. I think it's another one of those no-brainers. We've got 8 minutes remaining, and I thought if everyone could just switch their cameras on and hover your fingers over your mute buttons, and it's fastest fingers first. No, I really just want to find out a little bit more about what this sunset means for investors, because I guess in the marketplace there is now concern about whether or not investors will be made whole at exit. Because there is now no more new money that's going to be coming in post-June. So, Gaurav, maybe you can kick us off here. What do you think the sunset actually now means for current investors in Section 12J? Just unmute yourself there.
Okay, there we go. Sorry, it was just not letting me unmute. Yeah, I think it's a key question because some funds currently find themselves to be subscale, and so for investors this should be a consideration. If a fund is already subscale, it's not going to have the opportunity to raise more capital and reach scale at a later date. And so what's important to them, to investors, is to make sure that a fund is fully at scale. And that'll allow them the peace of mind that the fund management team can continue to run the strategy, can continue to be interested to be and pay costs, et cetera, and deliver the performance required for investors.
Right, thank you. I don't know if anyone wants to come in on that, because we do have one or two more questions around the sunset clause. So I'd like to get through to them. John T., maybe I can throw the ball down to you on this one. What were the reasons, tangible or otherwise, this is from Mzwandile Matthews, for Treasury to withdraw Section 12J?
Yeah, so in the commentary that Treasury published, what they said was that a lot of investments made by Section 12J funds were really in investments which would ordinarily have received the funding anyway. So they didn't actually require the Section 12J funding. And I think that what they're referring to there is obviously hospitality investments, hotel investments, which potentially would have received the funding anyway. This was quite a surprise for us, I must say. Having engaged Treasury many times, there was never an issue raised with where the money was going. But in fact, the legislation is very clear. It specifically states where we can't invest, and one of those the sectors is property, and then it says except in the instance of a hotel keeper, or in other words a hotel. So it was quite a surprise to us. They felt that the incentive failed to reach its objectives. And, for me, and you mentioned it earlier, is, if you've got an asset class that raises 11 billion Rand and only invests 4 billion, in other words, 7 billion sitting in cash, how in the world would it achieve its objectives? So I think the industry really dropped the ball here. Had more capital been invested at a more rapid rate, we would have seen high job numbers, invested companies paying high taxes, really giving Treasury something to brag about. But unfortunately, that isn't the case.
Yeah, one almost gets a sense that it wasn't also given sufficient time to be able to generate that momentum as well. There's another question, John, to you directly. Is your loan facility for any Section 12J investment? From Johnny Gound.
No, it's not. It's only for Infinity Anchor Fund. One of the reasons for being able to raise the funding was based on the performance of Infinity. So, if you look at its track record over the last 3 years, it's consistently paid a dividend, an average dividend of around 5%. And that gave the fund a peace of mind that realistically the dividend contribution would aid in the interest obligation or the payment obligation. So it's currently only available for Infinity Anchor Fund 2021.
Right. Just as we round off, and I think for investors at the moment, the primary concern is going to be the underlying quality of the assets that they're investing in. And just bearing that in mind, maybe Alex, you could give, from your vantage point, as someone who surveys the different Section 12J funds, just a bit of advice to investors before they invest into a Section 12J, before the sunset period closes. What do they need to be looking out for?
Quickly, can everyone hear you? So it's a very important question. What do they need to look for? At Safer, we've got a 21-point due diligence questionnaire. The first thing is not all 12J companies are equal. I remember there was one in the mining sector, rehabilitating mines, etc. The reason we got attracted to Jonty, etc., is having done a due diligence on many different not just unit trusts, but obviously 12J companies, was their very good cash deployment and very good dividend yields. So unfortunately, as the sunset clause, as my colleague Edward alluded to, the sunset clause comes to an end now. So I think anybody that's looking at their paying away 45 cents to the rand in tax, I think, again, we use that no-brainer, needs to put money in before the end of June into something like a 12J. I think a lot of people with the socio-political environment don't want to lock up monies potentially in RAs, etc. So I think the 12J, the last opportunity is to do this before the end of June. Am I correct, John? It's the end of June. And as I said, it's a bit like Animal Farm. All 12Js are equal, but some are more equal than others. In the particular round, it's the truth. I mean, where would I put my money, Michael? Here's the true test of a fund. Would you, you're an experienced commentator. Edward's father's an actuary, Edward's a CFP, graduate Stellenbosch. Where would we put our money? So when the viewers tune in, the first question I ask myself, would I put my money with these people? And we literally kicked the tires. In fact, I even went to see some of the funds that Jonty, I met a couple of the people where Jonty puts his money. I went to see for myself.
Yeah.
There was another well-known 12J company. I went to go and look at all their hotels. And I thought, is the occupancy levels right? You go and open doors and you talk to people. We don't just look at balance sheets. So the investors out there, I said, we don't just look at balance sheets. It's easy to look at a balance sheet. We like to go and see what's happening on the ground as well. And I think that's what the listeners and investors out there pay us to do. They pay us to do due diligence. So that would be my quick summation there.
Yeah, you've got to go out and kick the bricks. I think in this environment, we've seen in the listed space where you've thought something was AAA rated turn out to be.
Done that, hey?
Yeah.
Where the beds were going.
Well, on that, just one more comment from Treasury. I hosted a panel with Chris Axelson of Treasury and Dwayne Newman of Cova Advisory on this idea of, broadly speaking, why are Treasury withdrawing incentives? And it's not only the Section 12J. There are other incentives that have sunset clauses that they're not renewing as well. So I think philosophically, Treasury has taken a position where the finance minister said he wants to lower the corporate tax rate overall from 28%. He'd like to see it closer to 22%. And the quid pro quo is to then start withdrawing a lot of the incentives as well. So yes, there are industry-specific issues that Jonty raised, but I think philosophically, Treasury is also trying to get us to a far more generally competitive tax rate to stimulate the economy. With that, I think it's a no-brainer. Go out and kick the bricks a little bit further if you want to on the Infinity Fund. It's certainly one of the best that I've seen out there and one that I'd be putting my money into. Thank you very much to all the panelists, Alex, Edward, Gaurav, and Jonty, and look forward to catching up for a coffee at Croft probably sometime soon. Take care.